Join me as I dive into the predictions and try to figure out if we can really prepare for the stock market crash that's being warned about for 2025. The possibility of a stock market crash in 2025 has been looming over investors, with many experts weighing in on the likelihood of such an event. Economic indicators are flashing red, with inflation rates soaring and interest hikes implemented to curb the rising costs. Many experts believe this could lead to a significant downturn in the market, and some are even warning of an imminent crash. Market analysis suggests that the current economic climate is unsustainable, with many factors contributing to the potential for a crash. The warnings from experts are urgent, with some predicting that the crash could happen as early as this year. These predictions are based on a combination of economic indicators and historical trends, and while they are not guaranteed, they are certainly cause for concern. Inflation rates are a major contributor to the potential crash, as they erode the purchasing power of consumers and increase the cost of goods and services. Interest hikes are also a factor, as they can slow down economic growth by making borrowing more expensive. Geopolitical tensions are another factor, as they can disrupt global trade and lead to economic instability. The combination of these factors has created a perfect storm that could lead to a stock market crash, and many experts are warning investors to be prepared. One of the most compelling pieces of evidence for a potential crash is the similarities between the current economic climate and that of 2008, just before the global financial crisis. Experts are warning that the same factors that led to the crisis in 2008 are present today, and that investors should be prepared for a similar outcome. The urgent warnings from experts are not to be taken lightly, and investors would be wise to take steps to protect their portfolios. The potential consequences of a stock market crash are severe, and investors who are not prepared could lose a significant amount of money. The key points to take away from this are that experts are warning of an imminent stock market crash in 2025, and that investors should be prepared. Let me know in the comments what you think about the potential for a stock market crash in 2025, and be sure to check out my other videos for more financial insights. Welcome to our channel. Today, we're diving into a topic that's on everyone's mind, the stock market crash and the growing panic among experts. As we navigate through these uncertain times, the stock market has shown signs of volatility, leaving many investors anxious about the future. Recent fluctuations have raised recession fears, prompting discussions about what could happen next. With inflation rates soaring and interest rates climbing, the economic landscape is shifting rapidly. Experts are sounding the alarm, warning that a significant downturn could be on the horizon. This urgency is palpable, as many are questioning whether we're on the brink of a major financial crisis. In this video, we'll explore the current stock market situation, breaking down the factors contributing to this unease. We'll discuss the implications of a potential crash, not just for investors but for everyday individuals who may feel the ripple effects in their finances. So, if you're curious about what a stock market crash could mean for you and your investments, stick around. Understanding these dynamics is crucial, especially in a time when the stakes are high. Let's get started and uncover the reasons behind this growing panic in the financial world. Current economic indicators. As we analyze the current economic landscape, several key indicators suggest that a recession may be looming on the horizon. First and foremost, let's talk about unemployment rates. Recent statistics show that unemployment has ticked up slightly, currently sitting at around 5.5%. While this may not seem alarming at first glance, it often signals a slowdown in hiring and economic activity, which can lead to decreased consumer spending. Next, we have inflation trends. The Consumer Price Index has surged by approximately 6.8% over the past year, indicating that prices for goods and services are rising at an alarming rate. High inflation erodes purchasing power, making it difficult for consumers to maintain their standard of living. This, in turn, can lead to reduced spending, further impacting economic growth. Finally, let's consider GDP growth. The latest reports indicate that GDP growth has slowed to just 1.2% in the last quarter, a stark contrast to the robust growth we experienced earlier. This deceleration can have a direct correlation with stock market performance, as investors often react to these indicators by pulling back on investments, fearing a downturn. Together, these economic indicators paint a concerning picture, suggesting that we may be on the brink of a recession that could significantly impact the stock market and everyday life. Expert opinions. As we navigate the uncertain waters of the stock market, insights from financial experts can provide valuable perspectives on what lies ahead. Renowned economist Muriel Rubini has recently stated, "The risk of a significant market correction is higher than ever, given the current economic indicators." His warning underscores the urgency felt by many in the financial community, as he predicts that a downturn could be imminent if inflation continues to rise unchecked. On the other hand, some analysts, like those at Goldman Sachs, maintain a more optimistic outlook. They argue that while volatility is expected, the fundamentals of the economy remain strong enough to avoid a full-blown crash. We believe that the market will stabilize as companies adapt to the changing economic environment, they assert, highlighting the resilience of corporate earnings. However, the differing viewpoints among experts only amplify the urgency of the situation. Many agree that regardless of the outlook, investors should be cautious. Financial advisor Sue Zorman emphasizes, now is the time to reassess your portfolio and ensure you're prepared for any potential downturn. With such contrasting opinions, it's clear that the stock market's future remains uncertain. Staying informed and proactive is essential as we face these critical economic challenges. Historical context. To understand the current stock market climate, it's essential to analyze past crashes and the factors that led to them. One of the most significant examples is the 2008 financial crisis, which was primarily triggered by the collapse of the housing bubble and the subsequent failure of mortgage-backed securities. Leading up to this crash, warning signs included skyrocketing home prices, lax lending standards, and an over-leveraged financial system. These patterns created a perfect storm that ultimately resulted in a severe recession. Another notable crash occurred in 1929, marking the beginning of the Great Depression. In this case, rampant speculation and a lack of regulatory oversight contributed to an unsustainable market bubble. The sudden drop in stock prices caught many investors off guard, leading to widespread panic and economic turmoil. When we draw parallels to the current market situation, we can see some concerning similarities. Today, we are witnessing rising inflation, increasing interest rates, and a volatile stock market, reminiscent of the conditions that preceded past crashes. Additionally, the current overvaluation of many tech stocks raises red flags, echoing the speculative behavior seen in previous downturns. By examining these historical contexts, we can better understand the warning signs and patterns that may indicate a potential market crash, emphasizing the importance of vigilance in today's economic environment. Market reactions. In recent weeks, the stock market has experienced significant volatility in response to a flurry of news and events, reflecting the uncertainty that investors are grappling with. Stock prices have fluctuated dramatically, with major indices like the S&P 500 and Dow Jones Industrial Average seeing sharp swings. Trading volumes have surged as investors react to economic reports, interest rate announcements, and geopolitical tensions, indicating a heightened sense of urgency in the market. Investor sentiment during these uncertain times has been a mixed bag. Many are adopting a cautious approach, pulling back on investments and seeking safer assets like bonds or gold. Conversely, some are seizing the opportunity to buy into undervalued stocks, hoping for a rebound. This dichotomy in behavior illustrates the anxiety that permeates the market, as investors weigh the risks of a potential downturn against the possibility of recovery. Certain sectors have been particularly affected by this volatility. For instance, technology stocks, which had previously soared during the pandemic, have faced significant sell-offs as interest rates rise. Companies like Meta and Amazon have seen their stock prices drop sharply, reflecting investor concerns about future growth in a tightening economic environment. Overall, the market's reactions to recent events underscore the delicate balance investors must navigate, as they assess the implications of ongoing economic challenges. Protecting your investments. In times of economic uncertainty, safeguarding your investments becomes paramount. One of the most effective strategies is diversification. By spreading your investments across various asset classes, such as stocks, bonds, and real estate, you can reduce risk and minimize the impact of a downturn in any single sector. Asset allocation is equally important. Consider adjusting your portfolio to include a mix of growth-oriented and defensive investments, which can help balance potential gains with stability. Identifying safe haven assets is another crucial step in protecting your portfolio. Traditionally, gold and US Treasury bonds are considered safe havens during market turbulence. These assets tend to retain their value or even appreciate when stock markets decline, providing a buffer against losses. Additionally, consider investing in utility stocks or consumer staples, as these sectors often perform well during economic downturns due to their consistent demand. Staying informed and proactive is essential for any investor. Regularly review your portfolio and keep an eye on economic indicators and market trends. Subscribe to financial news outlets or follow reputable analysts to stay updated on potential risks and opportunities. By being proactive and making informed decisions, you can better navigate the uncertainties of the market and protect your investments for the long term. Remember, preparation is key to weathering any financial storm. As we wrap up our discussion, it's clear that the current stock market situation is urgent and requires our attention. With rising inflation, fluctuating unemployment rates, and slowing GDP growth, experts are sounding the alarm about the potential for a market crash. Their warnings highlight the importance of being vigilant and proactive in our investment strategies. Throughout this video, we've explored key economic indicators, expert opinions, and historical contexts that underscore the need for caution. We've also discussed practical strategies for protecting your investments, such as diversification, asset allocation, and identifying safe haven assets. Staying informed and prepared is crucial as we navigate these uncertain times. We encourage you to take these insights to heart and actively engage with your financial future. If you found this video helpful, please consider subscribing to our channel for more valuable content. Don't forget to like and share this video with friends and family, who may also benefit from understanding the current market dynamics. Your engagement helps us continue to provide you with the latest insights and strategies to navigate the ever-changing financial landscape. Thank you for watching, and remember, staying informed is your best defense against market volatility.